Volatile nickel prices, the start of CBAM taxes in the EU, the summer arrival of the bloc's new safeguard measures, and the continued Section 232 tariffs in the US, which are affecting global trade. What will 2026 hold? Those are the things we're about to discuss in this episode of Speaking of Steel. I'm Tom.
I'm Kaye. I'm Michelle.
Great stuff. Thanks for joining me, both of you. It's great to have you on board and great to have some insight into the stainless steel sector specifically. That's what we're looking at here. And, although Kaye's appeared in a couple of recent podcasts, carbon related with a little bit of stainless insight, it's nice that we've got that balance. And this is what you love, isn't it, Kaye, the stainless?
Yeah, good to have a stainless specific one for a change.
It goes without saying for you, Michelle.
Yeah, definitely.
So we'll kick off by just reflecting on 2025. It's kind of a format that we looked at with our Steel Price Outlook podcast late last year for the carbon sector. So if I can ask you first, Kaye, just reflecting on last year very quickly, what would you define as the key trends, the key drivers of steel prices in the stainless market in 2025?
So in terms of key drivers, I'd say uncertainty and a lot of caution ahead of what was to be the implementation of CBAM in Europe, if we're talking Europe specifically. So a lot of people bringing in imports ahead of that and preparing for all the unknowns, really, in terms of supply from January the 1st, especially with a lot of people not really knowing what the costs were going to be from the CBAM charges. So we had a lot of people sort of stocking up a little bit in terms of imports from Asia, and also weak demand across Europe in general. So we had prices in Europe being quite weak and undermined a little bit by import pressure. Across the pond in the US, it was slightly different. The main driver there was raw material costs, a little bit from the US alloy surcharges. We had a big base price increase in the middle of the year, which by and large was accepted in the market, although it was quite a big increase, and that was largely to do with the tariffs. And then Asia generally was all raw material costs again, but oversupply still been a big driver in that market. So, but generally overall, last year wasn't an amazing year for stainless.
No, not for many things.
Not for many things, no. And everybody's hoping that this year will be better. And so far, it seems to have got off on a slightly better foot price-wise. And everybody's hoping that prices will now start to move upwards going forwards. Obviously, we've had some other things that have happened this month. Well, in January, I say.
Well, we'll get into that. We'll get into that. Certainly,
yeah. So it's been a slightly more interesting start to 2026 for a variety of reasons, which obviously we'll talk about. During this episode.
Michelle, I guess Kaye's given quite a good summary there, but you're very much finger on the pulse of the stainless steel review. Lots of research calls. What was the mood amongst MEPS respondents in 2025?
Yeah, I mean, everybody was, like Kaye said, very, very cautious last year. There was a lot of uncertainty. Demand was weak in all regions, really. The US market started off a little bit better, and then after the doubling of the import tariff and the big mill increase that we saw in June from the stainless producers out there, demand started to, I guess, mirror what was happening in Asia and Europe then. And that continued right up until the end of last year. People's, sentiment last year was quite negative, really. Very, pessimistic about what was going to be happening, where the market was going, what their options were going to be. And then obviously in Europe, like Kaye said, we'd got CBAM that was coming up to start with charging in January. So again, the market was really pessimistic about, what impact that would have. There was a lot of import material coming in. And that reflected in the prices in Europe in the second half of the year. Actually, we saw, the prices the domestic mill prices coming under a lot of pressure. because, there was a lot of import material coming in preparation for this year. So, very, very pessimistic amongst everybody, really, last year. There was very, I guess, limited pockets of more positive news.
Yeah, yeah.
We've seen some sort of almost alternative supply or alternative effect from CBAM as well in Europe impacting on the US, haven't we? Because what we saw was the Asian suppliers who can't ship, or not can't ship, but have been priced out of the European market a little bit. I mean, we've seen them target some of the US market a little bit more, haven't we? So
yeah, because the prices in obviously the US market are some of the highest in the world, and they're, I guess, more lucrative markets for them right now. I was in Maastricht in November for the Stainless World, and there was a lot of importers that were at the event, and we did speak to quite a few of them, and they were all saying that their bookings had dropped off massively after the summer last year, especially for Q1 delivery this year. And gosh, we can see that in the import numbers on certain products that have come in January, where quotas that are normally filled within days have got nothing,
Yeah.
still 96, 97% available, and we're into February now.
yeah, and those same Asian suppliers are targeting and have been attending the US conferences more, trying to find new, sources of, supply into the US market, trying to target some of the big US service centres to sell to those instead. Because they can see an opportunity really to supply there instead with those higher prices in the US market now. So we are seeing a little bit more import penetration going into the US market. So we did see some speculation on whether there might be another base price increase in the US market towards the end of last year, and that sort of didn't happen, and that now is not really coming out anymore. We've got more domestic capacity coming online in the US market. We've got a bit more import penetration coming in. So whether that's actually going to come through now is probably less likely.
Yeah, what quite a lot of our research partners in the US market, the import were saying, is that the doubling of the 50% didn't necessarily just restrict
the doubling
imports.
of the 25% to 50%.
50%.
Yeah.
What effect it did have is that it levelled the playing field. So countries like South Korea that had, quotas suddenly were on par with, Vietnam with a 50% duty. So what we saw when we looked at the import statistics for Q4, particularly last year, was that there was a bit of a switch round in the countries that were supplying into the US market, and traditional ones like Taiwan, Europe, France, Belgium, had all had quite a big decrease in the imports coming in. But then countries like India and Vietnam had seen an increase.
Yeah.
The effect had not necessarily been a reduction. It has started reducing, but the biggest impact was actually a switch round in the countries that were most popular. And they're obviously the countries that are struggling to supply into Europe right now as well.
Yeah.
But, whatever the prices remain at the levels that they're at in the US market, then, imports are going to stay competitive, even with the 50% duty.
And is there an expectation, I'm aware you're fresh from, writing parts of that European, the European and US overview of stainless steel review. Is there a view in the US that trend will continue, imports will continue to be attractive and prices will remain high? Because demand, as we've already heard, is not great, is it?
No, demand expectations in the US market for this year are pretty much, I guess, again, on par with Europe and Asia. Very similar picture volume-wise. A lot of the reasons why people were very cautious last year are still around this year. So people's expectations for demand are still very much very similar to last year, sorry. But from a pricing perspective, the US prices are likely to stay higher. An increase from the mills at this point is looking unlikely. because we haven't really seen an increase in bookings with the domestic mills. So the imports have started to drop, but we haven't seen that reflected in the lead times from the domestic suppliers in the US market. So really, it's just indicating that there's been a cutback in people's buying. And it's from the conversations that we have with research partners, I think that's just starting to come into conversation a bit more now, where people are commenting, you know, that the stock levels are maybe heading to a more medium level, because people have just cut back on the amount that they're buying, unsure about the market. We've seen there's been a big increase, obviously, in the alloy surcharge for February.
Yep.
So a lot of people will be trying to hold off on taking material in this month at the higher surcharge. But overall, yeah, I mean, the pricing expectations are to remain elevated, and demand expectations very similar volume-wise to 25.
And we've talked previously in discussions about Europe and the US about these import restrictions, be they tariffs or quotas, sort of undermining the business model of distributors and service centres. Is that something that's happening in the US? Is there a risk there to certain businesses, or you know, are we going to see the import situation settle down in 2026? Do we think?
I think in the US market, you're less likely to find the US mills going direct to the end user market, which is what we do see in Europe, especially when demand's quite low. You know, the mills tend to, you know, look for alternative sources of getting orders in, whereas the US market's a bit more disciplined, I think, in that respect. So, you know, they're looking more at trying to get more volumes to the master distributors, rather than targeting the smaller volumes from, you know, the smaller buyers. I guess the only thing we did see in 2025 was that the US domestic mills were targeting some of the customers who they'd essentially cut off in the pandemic when they were really busy. And we had seen them come back to the market for those particular customers, trying to entice them back in with some really, you know, good discounts. But I guess more towards the end of last year, even that had settled, and you know, the discount levels, the mills were holding firm, and you know, they weren't negotiating on prices as much. So yeah, the US market's a bit more disciplined in that respect than what we see in the European market.
I think the main thing we were seeing in the US market towards the back end of last year, obviously, was the mergers and acquisitions between the large service centres. So, you know, we saw Clockner and Worthington and Olympus, Ryerson. So we saw those mergers and acquisitions going off a little bit more in the US market. So we might see a little bit more of that going forward potentially in 2026. You know, as companies try to, I suppose, position themselves in a better place to compete in the US market, and I suppose take a bigger market share, and create, I suppose, more master service centres. Yeah. And that makes them in a better place to be able to serve the customers.
Interesting. Well, one of the factors early in 2026, which we've seen as a clear influence on prices globally, is the volatility of nickel prices. You mentioned it, Michelle, having an impact on the US alloy surcharges in the month, if not the months ahead. Kaye, can you just sort of outline what we've seen so far and I guess give an indication of where we're at and what we're expecting?
Yeah, so I mean, nickel's had quite an interesting start to 2026. So just before Christmas, the Indonesian government announced that they were planning to cut the mine permits for 2026. Quite a significant cut on what the permits were for 2025. So that's not going to be ratified just yet in the Indonesian sort of parliament. But what we saw ahead of that was just after the Christmas, or the European Christmas break, was that the Chinese buyers basically piled in and bought a lot of nickel, and that sent the nickel price soaring. That was fueled a little bit by just general trading across the metals market as a whole, That wasn't just nickel, that was copper, gold, silver. A lot of the commodities basically moved up alongside them. So we saw quite a big spike in nickel during January. I think at one point it went towards $19,000 a tonne, and we're talking from $14,500. So we're talking quite a big rise in nickel during January. That's obviously pushed alloy surcharges in the US quite high for February. It resulted in Asian mills pushing up their domestic and export offers up across the region. So that doesn't just affect sort of Asian sort of selling prices for cold roll, but it also impacted on sort of Tsingshan's export offers for their slabs and for their hot rolled, which is used as an input material for the Taiwanese cold rolled, for instance, and the Chinese. So it affects a lot of things price-wise in Asia, and that also gets exported to Europe. So it impacts the import price in Europe, which has assisted the European mills in also putting prices up, as well as the CBAM impact in Europe. So it's pushed global stainless prices upwards across the board. The nickel price, however, wasn't backed by any fundamentals in the nickel market. It was literally just this announcement on the nickel mine permit cut, which hasn't yet come through. It hasn't gone through the Parliament. So we've had no actual details on how that's going to operate. In the last few days, that buying sort of subsided a little bit. We're coming up towards Chinese New Year. The details are a bit scarce, and the traders have sort of realised that the fundamentals aren't really there, and they've started to retreat back a little bit. There's also been a few things that have come out of the US in terms of sort of Fed sort of policy and how they're going to impact on the inflation going forward, and there's a little bit more negativity now in the market, and nickel has come back off. We're now back to around the $17,000 a tonne now for nickel. And it sort of seems to have been trading around that now for the last couple of days. So if that sort of stays where it is, which is actually the Indonesian government's target
around
price, is around $17,000 a tonne. So, I mean, the likelihood is, if that's where it's currently settled at, and that's the Indonesian government's target to keep it at that, it's likely that we're probably going to stay around that, or at least hover around that. Now, bearing in mind, nickel never likes to stay at any one point. So it could be that it might move up and move down, but trend around that sort of level over the next few months, or like next few weeks at least, until it finds its level. So if we stay around that $17,000 a tonne for the rest of the reference period for the US alloy surcharges, for instance, then the US surcharges in March are likely to move up a little bit. Not as much as it would have, obviously, if it would have stayed above 18 or 18.5 where we were just a week ago. But we are still expecting a small rise, maybe $30, $40 on 304, upwards of maybe 70 on 316. Although it might be a little bit more on 316 actually, because we've got some molybdenum issues. Yep. We had an explosion at a mine in Pennsylvania just the other day. So there are some other things that can affect some of the other grades, obviously. So there are still a little bit of upward pressure on the US surcharges for March in the US. However, that drop down on nickel in the last few days will impact on Asian prices that tend to react pretty quickly to any fall in raw material costs. Although, saying that, all that upward increase in nickel hadn't been fully reflected in the Asian prices. So, yeah, it's all still to play for, if you ask me.
But it had been originally described, the nickel increase as a spike, I guess, by various commentators. And I think we'd referenced that. It was an accurate description.
Yep, we said that just last week.
Yeah, so I expect, it will moderate a bit, but the way all the dynamics are in play, then it's not going to be a price decline as such, is it?
No, I mean, it had already overshot the fundamentals, and I think actually we published an article on the day that it spiked towards 19, which was, it was like, ooh, okay. But then literally the day after it dropped, which, I mean...
Yeah, interestingly speaking, we're obviously our research partners across, the different continents. The general feel from everybody that we spoke to in January was they had a massive lack of confidence that the nickel was going to stay at the higher levels that it was reaching towards mid-January. So, I guess most of them will be sat there now looking at today's nickel price thinking, yeah, that's exactly why people didn't have a lot of confidence in it.
Yeah.
And that just wasn't the US contacts talking about their big alloy surcharge jump for February. This was people, in Europe who, to be honest, don't tend to follow nickel as much as what they used to. And in the Asian market as well, they follow it so closely, but yet even they were sceptical about it holding.
Yeah, and I think that's part of the reason why the Asian prices hadn't fully reflected
Yeah.
all of the increase in the nickel, because
Yeah,
I think a lot of the Asian mills were not confident that that nickel price would stay as high as it had, and I don't think they wanted to push the prices up to only have to bring them back down again. So I think
already struggling with obviously CBAM.
Yeah.
And the impact that's had on their exports as well. So very, very cautious about putting their prices up too much. Weak demand in their home markets. So yeah, like Kaye said, we didn't really see maybe the full reflection of what was happening with nickel in the Asian pricing last month. And I guess that we'll already start to see some weakening in that sentiment in February, as they're still, looking for markets to export to, with all the different trade measures that have come in.
Well, timely introduction to those factors in our 2026 outlook there, Michelle. So I was going to start asking a bit more about CBAM and the effects of that in 2026, because we've seen in January the implementation of taxes, at least theoretical, that will be charged in September 2027. But it's created a lot of confusion and uncertainty in recent months, and I guess that's not changed, has it? But I want to talk a little bit about the supply dynamics that's playing into. Michelle, I'll start with you, because you've been researching in January and getting people's response to those factors. What's the main complication that people are talking about right now? I guess it's price uncertainty still, isn't it?
Yeah, I mean, the uncertainty around CBAM has kind of increased as time's gone on, and the date's become closer. And the biggest issue at the minute is that buyers don't know whether to use a default value or whether they can rely on a pre-verified value from their supplier. And it doesn't look like the verification process is going to start until September, October. The framework for what the verification is still being drawn up. So it doesn't look like the verification process is going to start till September, October, which means that really for the whole of this year, people are going to have to estimate what their CBAM charge could be, which they will be liable to pay in 2027. And what most contacts or research partners are saying to us when we're speaking to them is that some of them are confident in their suppliers. They've got good relationships. They're very well-known producers, and they've got a good reputation in Europe. And in that case, they are more likely to calculate what they think their CBAM charge will be based on their pre-verified value. However, if they're not an integrated supplier and they've got a more complex supply chain, or if they are a supplier that's not as well known or doesn't have the reputation that some of the bigger suppliers do, then they're more likely to use the default value just as a worst case scenario. Obviously, we've seen some of these CBAM charges could be quite big, 400-500 euros a tonne based on the default values,
or even higher.
Or even higher.
Yeah,
so
it's
a big risk, and people are worried that they're going to get to 2027, start declaring what they brought in this year, and be hit with the default values, and suddenly their bill jumps up massively, which they're liable to pay. And like I think I alluded to earlier, we've kind of seen that reflected in the imports coming in January, because cold rolled coil, for example, is one of the ones where people are very cautious, and we've seen a massive reduction in the volumes arriving in January. Indian longs, different matter altogether. So what we've seen there is that the imports have arrived as normal. because even with a 400, 500, 600 euro charge against them, it still doesn't cover the gap between the import price and the local price.
That's some gap.
You know, you've got nearly €1,000 a tonne in between. So, you know, and they're hoping, obviously, because a lot of those suppliers have got fairly good pre-verification values, that they'll never actually have to pay a default value on the Indian longs that come in from, you know, their traditional suppliers. So we didn't see a reduction in that particular product. But then, as we're heading closer into, you know, the middle of the year, people's thoughts are now for delivery. Most people are turning their thoughts now to what's going to happen with the safeguard replacement
from
proposal,
July 1st,
which would come in from July 1st. You know, so we've only, you know, April's going to be the last opportunity to bring in specifically the Indian longs before we're looking at a potential quota reduction, as well as the CBAM charge.
And an increased tariff.
And an increased tariff. So, you know, a 40%, 47% reduction in quota and a 50% duty on the above quota volume suddenly changes the situation for the Indian longs as well. So some products are going to be hit with, I guess, a double issue. So
yeah, I think the Indian bars were already above quota in Q1.
Yeah,
and I think that there was talk that they were hit with a 9% above an average, because obviously that's how it works when it goes above quota. So the total amount that was imported, everybody got a 9% above quota tariff applied to them. So obviously if that was the same in July, on the 1st of July, it wouldn't be 9%, because obviously the quota volumes would be reduced, and it would, you know, be
and
applied
the tariff
at
would be double.
50%. Yeah, so I mean, what would the tariff be on a lower quota volume and a higher tariff? I mean, that could make the difference between it being worth importing and not worth importing. So people have got to weigh up now whether, you know, they're going to be importing from the 1st of July. So
yeah, interestingly, we haven't seen, I guess, the same kind of confidence from the European long producers as what we've seen from the flat producers, who've been quite quick to ramp up their pricing in response to the reduction in imports and the introduction of the CBAM charge. With the longs, there's a little bit more confidence, but they haven't really gone for the big increases.
they're trying.
They're trying. But I think as we head closer to the summer, then I think we'll probably see that start to pick up pace like we did with the flat products. I think we're just going to see that little bit of a lag effect where, you know, the CBAM effect is less, but the safeguard will have a bigger impact. Whereas with the flats, obviously the CBAM's been enough for most products
The problem with Europe, though, is that there will always be a ceiling price or a cap on how much they can push prices up, especially in longs, with the Indians being so cheap, and they are starting to reduce their offer prices in order to account for some of that. And it's the same with the flats. You know, that there's that ceiling price that once the European mills push the price too high, that it will account for that charge on CBAM or the above quota issues, tariff issues. So, you know, it's always going to put a ceiling price on the European flats and bars price in Europe.
A lot of our research contacts, particularly in January, actually, you know, were reporting back that they were getting, you know, they were becoming a bit more concerned that we were going to see a similar situation to what's happened in the US market, where obviously we've seen a big import tariff come in. And the domestic producers lifted prices quite significantly. I mean, they did it all in one hit, whereas in Europe we're seeing this gradual month-on-month uplift in pricing. But people are starting to wonder whether the European mills will get a bit too confident and lift them too much, in which case we'll see people looking back towards the import market, because the reports back from people so far are, yes, there has been a slight increase in what they can sell their stock to their customer base. It's not going up at the same rate as what we're seeing the increases from the producers. So you know, even though their selling prices are going up, the margin's still being squeezed, essentially. So, you know, there's always going to be the eyes on the import market, because for some companies, that's their only way to keep competitive in the market.
As we spoke about earlier, you know, there's certain business models that just won't adapt
Yeah,
to those
exactly.
higher prices.
And you know, I guess we'll start to see we could potentially see a similar situation to the US, where we're starting to see a lot of acquisitions and mergers with companies whose business models are maybe not equipped to deal with the market conditions that we're going to see in the next 12, 18 months.
Kaye, you mentioned a couple of instances of very high CBAM taxes or projected CBAM taxes on stainless steel. What areas in particular are really going to sort of disrupt the supply chain in Europe? Where are things off the menu, as it were?
So one of the ones that is commented on a lot at the moment is Taiwanese cold rolled, for instance. That seems to be one that most importers are steering clear of. Not everybody. We have heard the odd instance of some people still importing from, or has, you know, some orders still on from Taiwan, but the projected CBAM charge for Taiwan is still quite high. I think there is one or two that are still prepared to take that risk in the hope that verification process will take place and it will come in much lower, but the majority of people are steering clear of the Taiwanese imports because that CBAM charge or the default values is very high. Obviously Indonesia, pretty much been off the menu for a while anyway, because everybody expected that one to be quite high regardless. Yep. They're the main two. Vietnam a little bit more as well for the same reason. There's a little bit of confusion about Malaysia. Some people expect that to be fine. It's a little bit lower, but then some people think, well, maybe that'll be higher because they're using 100% Indonesian raw material as their input, and they don't know whether the Malaysian default values will need to be added to some of the Indonesian. So there is still some confusion about some of the CBAM default values and the CBAM charges, depending on where they're buying from. So yeah, we've had a lot of questions coming in from people about some of those figures and how they calculate the CBAM charges. So still a lot of people coming to us and asking a lot of questions on those.
Yes, you know, if they've not got the integrated supply route, it becomes a lot more complicated to work out what the charges are going to be. And unfortunately, Malaysia, Taiwan, Vietnam, because they don't melt for the most part, their own, you know, they're reliant on the Indonesian.
Yeah, well, and the Taiwanese have got melting facilities. The problem is they haven't been melting. They've been using the Indonesian feedstock, but they have started remelting again in some instances. But they're not sure how the verification process will work and whether they'll take the new CO2 emissions from the facilities that they're now melting from, and whether they're going to be doing dual supply, whether they'll melt for just the European supply and not melt for the non-European supply, and whether they'll allow that under the verification process. So there's still a lot of questions to be answered. So
yeah, a lot of juggling of supply sources, and it does bring into question that carbon leakage idea, doesn't it? If certain products are being prioritised for the EU market and you know, dirtier products as they were are going elsewhere, it's unusual. And of course, a lot of European businesses were using that Indian feedstock as well, weren't they, Michelle? So there's a change there as well in
the Indonesian slab that was coming in. I mean, there was quite large volumes coming in, especially last year, and we had another big influx of slab come in just before the end of the year. Obviously, that's now going to be subject to CBAM charges. It won't be impacted, I don't think.
It's not included. It's not included in the quotas,
no.
Which is a comment that keeps coming back to us as to why it's not. But
but it will have the CBAM charge, and obviously it is quite high because of the melt country.
Yeah.
So I guess we'll have to see whether that is still a thing this year. I mean, I don't think so. I think especially if they have to use the default charge, I think that's going to make it a bit of an uninteresting method going forward. So we might start to see scrap prices recovering in Europe at some point if...
Yeah, they have started to move back up again, scrap. We did get some comments during January when stainless prices and nickel prices were moving up, but stainless scrap hadn't yet started to move up at that point. And some of the distributors and service centres were complaining about, well, we can't sell our scrap for any more yet, but our obviously buying prices are going up. But then by the end of January, they had started to increase. I think the service centres were pushing back with the scrap traders. Now, whether that will continue now that nickel's starting to come down, I don't know, because obviously in Europe, they, like Michelle says, they don't tend to follow nickel as closely. They do keep an eye on it because it is still of concern to the European buyers, but generally it's the stainless scrap and just the general import price and everything else that they take or pay attention to. So that stainless scrap price should in theory start to or continue to move up, but we shall have to keep an eye on that one going forward because that will have an impact on stainless prices in Europe.
Yeah, I think there's enough Indonesian slab stockpiled at the mills for the foreseeable future for it not to be an immediate issue.
They are still working through that as far as I'm aware. And there was a rumour that there'd been another shipment leave that's due to arrive, but I've yet to have verification on that. When I did look into some of that and I haven't been able to prove that that's the case.
So are these trade defences and the effects of CBAM in Europe and the US, are they a key driver of prices in Asia as well? Will they continue to be in 2026? What's driving the Asian market this year? Michelle, I'll ask you that.
Yeah, I mean, I guess it's a bit two-tier in the Asian market because they've got their local market for their sales, and then they've got their export market. Their local markets are expected to stay relatively, again, similar to last year. I think that's kind of the picture we're getting for all the different regions. So demand-wise, we're expecting a very similar year in the Asian market. So on their home sales, I think prices are going to stay under pressure because of a lack of demand. Their export prices, obviously, are a bit more reliant on what's happening with the outside markets. And as more and more trade barriers come up, obviously they're having to adjust their strategy to be able to keep selling to certain markets. And I guess what we saw in Maastricht particularly was that the ones that did come to the event and were really worried about how much their export numbers to Europe had fallen in the last quarter of last year, were offering all-inclusive prices. So they were taking the risk of CBAM. So I guess from their long-term perspective is that they're also banking on their pre-verified values being accepted, and people will be able to work with them. So I think, by the middle of next year, when we have a list of suppliers and verification values that people can use, then I think I guess their strategy might change again. But I think this year is going to be really tough for them because they are literally battling barriers in lots of different ways. You've got melt and pause, you've got quotas, you've got 50% duties going into the US. That's a lot for them to try and navigate around.
It feels like that 50% duty in the US now, because it's stable, it's set. The suppliers into that market have probably, adapted now.
Yeah.
And the steelmakers there are benefiting from higher selling prices, higher profit margins, but trade is going to continue after a point, and I suspect the US is probably a lot more appealing at this moment in time than Europe, is it not?
Yeah, like I said, the import numbers for Q4 last year were the first ones really where you could start to see the impact of the doubling of the 50% tariff, because that came in June. So, by the start of Q4 arrivals, that was really when people had backed off, the ones who didn't want to take the risk. So that's when we started to see. But I guess it'll be interesting to see what happens in the next couple of quarters. But I think we'll probably see maybe a plateauing of those imports, because I don't think they'll continue to drop, because like you said, people have adapted now. And most of our research partners in the US have been saying for several months now, you know, even if they're not in agreement with the 50% tariff, it's more a case of, okay, that's what we've got, that's what we need to work with, and we can now make our strategy based on that. You know, their concern is that it changes.
Yeah, the biggest fear is part of it being removed.
Yeah. I mean, we still speak to people who, you know, had material en route when it came in, who can't afford to pay the 50% duty or don't want to, who diverted material to other countries to avoid the 50% duty. There is material in port warehouses waiting or hoping maybe for the duty to be reduced so that they can bring the material in. So, you know, we will see that continued reduced, I guess, import activity, which is probably a two-tone as well. You've got the doubling of the 50% tariff and the doubling to 50%, and you've also got reduced demand in the US market for several months. You know, their PMI readings are no different to other countries. You know, to say that they were in a better position heading into this than other regions, you know, since at least 2023, you know, their PMIs are only gone above 50 twice.
Yeah.
So, you know, their home market conditions are, you know, suffering like everywhere else with all the uncertainty, and, you know, there's just so much happening outside of the steel market's control as well.
Yeah, that might be the story of 2026. It's fast feeling that way.
Yeah.
We'll just sort of summarise and reflect on what the outlook is for this year. I think we've been doing that throughout the pod, but if we could just quickly, I guess we're going to bookend this podcast with hopefully not too similar takes, because some people might be expecting a change in 2026. Kaye, what are your overriding expectations for the rest of this year?
If we're talking about a change versus 2025, I would say higher prices in comparison to 2025, but that's going to be driven mainly by higher raw material costs, a reduced supply in certain regions like Europe in terms of CBAM. We've got obviously reductions in some countries in terms of production. So we've got export taxes out of China, which is helping in terms of taking out lower cost exports into Asian regions. But then we've also got new capacity due on stream in stainless, but that'll be later on this year. We've also got new capacity due on stream in the US, but then higher alloy surcharges in the near term. So it's mainly going to be driven, I would say, by raw material costs and supply-demand balances. An improvement a little bit in demand, but not massively globally.
That's as positive as I was hoping for. Thank you. Thank you. Michelle?
Yeah, I mean, very similar sentiment. I think this year is going to be a story, a lot of supply restrictions, mills having more confidence especially in Europe, to increase pricing. Hopefully that will translate into better margins for the stockists and distributors who've really struggled with the margins more than volume in the last few years. So, even if they only have a marginal improvement in volume, if they have a better improvement in margin, then that's going to feel a lot more positive for them. I don't think any of them would would not want that.
I'm sure.
But yeah, I think pricing is going to be the key thing, I think, this year. Even if we don't necessarily see any big changes in volumes, the pricing is going to be the key. And I guess the one to watch out for in Europe in the next few months is the safeguard replacements. So, what impact they're going to have moving forward. Another big question that I guess we get asked quite a bit now is, with all the import restrictions coming into play in Europe, are the domestic mills set up to take all this extra demand? I mean, we know that they've been running at, they've not been running at full capacity for a long time. No. So are they prepared? And what impact will that have? Will they be able to supply the difference?
Yeah, certainly. No one's anticipating a surge in demand, but certainly that supply balance is going to change.
Well, that's it. It's not necessarily an improvement in demand. It's more a switch.
Yeah.
We're talking to a lot more of our research partners now who have gone back to buying from the European mills because their imports options have become more limited. So it's what's going to happen to the capacity. Can they keep up with it? Will the lead times move out? So there's, I guess, a lot of things that are going to happen in the next few months as the situation evolves, I guess.
Well, more positivity in both of you than I anticipated there, but still questions that we'll look to answer in the stainless steel review throughout this year. So I guess people, that's where you need to find your answers.
Yeah,
subscribe to the stainless steel review and we'll try and provide them.
Yeah, and hopefully we'll hear more detail on the safeguard changes from July, because we still haven't had all of that yet.
Well, as well as the reviews, I'm sure we'll be back in a podcast studio to shed a bit of light on that when we've got more information. Michelle, Kaye, thanks ever so much for your time. Great podcast. And I'll see you again soon. I'm sure I will.
Thank you.
Thank you for having us, Tom.